Hello friends, hope all of you and your families are safe during these times. In the next few minutes, I am going to take you through the key events of the recent past and Kotak Mutual Fund's view on equity markets. Since the lows in March, equity markets have pretty much gone up in a straight line without too much of corrections in between. September saw a small flutter in that context as Nifty intra-month fell by 7% even as they retraced most of the correction towards the end of the month. This was primarily prompted by drops in global equities, especially in the USA ahead of their presidential elections. The volatility in global markets saw dollar index appreciate. Even precious metals like gold corrected by 4% in dollar terms. Silver corrected even more sharply by 15% in September were not spared in this correction. From the lows in March, large cap indices like Nifty and Sensex are up close to about 50%, mid cap index up by about 55%, and small cap index up by almost 75%. September also saw mid and small caps continue to outperform large caps. However, these large moves come after a very sharp correction that the broader markets, especially small caps, have seen since 2018, and also the very large fall that the overall market saw in Feb and March once the lockdown got announced due to COVID. With respect to flows, data till September 29th suggest outflows by the FII to the tune of almost $1.4 billion, while DIIs were marginal sellers of less than $50 million. Last 4 months, FIIs were big buyers of Indian equities as a lot of companies and banks were raising capital to shore up their capital and equity capital, pumping in almost $5 billion. So in this month, amidst a global correction, they seem to have pulled out some allocation away from Indian equities. As India moves from lockdown to various unlock phases, various high-frequency indicators have posted mixed trends of late. On the positives, power consumption. Power consumption has reached 108% of last year demand in September 20 from 90% that it saw in August 20. Also, basis the trend seen in the first 20 days of September, it looks very likely that the e-way bill generation is likely to see YOY growth, the first time since Feb 2020. Daily car registrations, again, reasonably healthy at about 88% of FY20 levels. And the positive data point is air travel, gaining momentum to close to about 140,000 daily flyers. This compares to about 112,000 daily flyers in August of this year. However, of course, on a pre-COVID level, that number was close to about 400,000. So clearly a long way to go in terms of normalization of air traffic. Now let's look at the negative data points. Diesel and petrol surprisingly have contracted by about 18% in August compared to the previous 3-month average. Credit growth continues to be very slow and tepid. Most banks and lenders are currently focused on moratorium, collections, and therefore are very wary of extending new credit. Credit growth was very slow at about 5.3% as risk averseness is very high. Another negative data point was non-oil and non-gold imports. This declined by about 30% in August, signaling weak domestic demand. COVID-induced lockdown has definitely slowed down the economy and has pushed out earnings for corporate India by at least a few quarters. However, in our view, unorganized sector has faced the brunt of these challenges as they have limited access to funds as well as a lot of labor has gone back to the villages in the rural hinterland. This to us presents an opportunity for well-managed companies to gain significant market share as and when demand normalizes. However, this is all in the medium term. For now, the focus is on betting on companies that will see through this difficult phase, even as they don't lose sight of the bigger opportunities in the medium term. Given this, our focus in most of our portfolios is A. to maintain diversified holdings, B. focus on companies that have low or no debt, C. have higher margins than the competition, and D. broadly gaining market share over the last few years. Broadly, this manifests itself in playing 4 sub-themes across most of our equity portfolios. Number 1, financialization of savings. This is particularly a play on the savings pools of households, focusing on franchises which are in the insurance space, capital market space, gold retailing, payments and cards, etc., which may see a greater focus during these times. The second sub-theme that we are betting on is getting back to work. Essentially, as India goes from lockdown to unlock, in the various stages of unlock, we believe workplaces and factories are going to require a lot of things like telecom, gas utilities, consumables that go into making the workplaces and factories come back to life. The third sub-theme that we are focusing on is consumer revival. And this is across a whole range of categories, including FMCG, food, retailing, personal mobility, rural, etc. And lastly, we are playing a sub-theme of focusing on companies that are part of the global business chain. Think of companies, for example, in the sectors of IT, pharma, chemicals, auto ancillaries, capital goods, as we think that the global business is likely to stabilize much faster than the Indian economic environment, given the massive stimuluses various advanced economies have given so far. It was the best of times, it was the worst of times. Charles Dickens wrote this in his novel A Tale of Two Cities in 1859. In many ways, it appears the current times of COVID are no different. Yes, there is a lot of damage to economic activity currently, but there are also newer business models and opportunities emerging. And therefore, one needs to strike a very good balance. Don't get carried away by extrapolating all the negative news flow that we see today. Not get carried away by believing that every company will be able to transform themselves and evolve themselves into futuristic business models. Which is why asset allocation, systematic investment and discipline is to us the most important mantra as we navigate during such times. Needless to say, equity as an asset class is best suited for longer term goals. We therefore continue to suggest to allocate to equities in a disciplined and systematic manner through systematic investment plan. Thank you friends and stay safe.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.